the direct comment was, yeah, AGI 38.90, 41 put, high cost basis of 45. You've got about a 10% probability of making any money on that trade. And the comment is correct. If, and only if, I hold this position all the way to June expiration, accept no dividends. It's not a great dividend, but AGI does pay a dividend. Do no income methods. Don't adjust my put. Don't sell calls. Don't do any of the riskless spread trades, the money nets, income method number 5, 6. Use income method number 11, another riskless spread trade. I don't add an extra put around earnings to protect the downside or profit in both directions. You're absolutely correct. I do nothing on this position, and I somehow managed to tell my broker and change all rules of investing and say, I don't want the dividends paid for AGI, give them to someone else. I don't even know how that would work. But yes, I need the stock to be at 44.80 at June just to break even. That is correct, assuming I do nothing. What is the probability that the stock will be trading at $41 or above at June expiration? Well, I can go to the options chain to see that, but I'm just going to go here. Right now, we're updating all of the historical data for the end of day data, so it's fighting with two different chains. So the option chain is probably easiest to get to. I'm in puts only, not historical data. I want to go to March No, this was June, wasn't it? Yes, June expiration. My apologies. Markets June expiration. There we go. 153 days out. We are looking at the 41 put at 590. Midpoint roughly. And probability above, it's better than I thought. 43.5%. There's a 43% probability the stock will be trading at 41, but that's not what we want, Mark, is it? No. 44.80, right? That was our cost basis. So what is the probability of the stock being at 44.80? Let's just call it 45. Probability is at 33%. Still a little bit higher than I expected. You mentioned, expected to be around 20, 25%. There's a low probability of profit on this position. That's correct. 33% probability if I do nothing, but that's not what our plan is with the married put. We're going to be actively trading this. We're going to be doing income methods. That's why we're buying the put so far out in time. So we have multiple months between now and then to generate that income, manipulate that second working asset, our put option. Leave the upside open through earnings with that riskless spread trade we showed, income method number 6. Now, we all want the home run, don't we? We all want that power play and that structure that gives us the best return. Conversations I've had this week. Gentleman was looking, I don't have it here, but let's go ahead and get to it. I'm going to go to other strategies real quick. I need Bull Call Debit spreads. I don't have it in my selected 11 tabs, but it's one of the 23 strategies we can select here. So let me go ahead. Oh, naked call. We don't need that. I don't want that. I don't need it. Let me add Bull Call Debit. All right, let's save the configuration. Let's go to Bull Call Debit and let's go to search. Now, we might go shorter term. We might go monthly, Mark. I'm going to look at these positions and say, okay, I'm looking for a good 80, 60. Wow, Mike, you're looking for high returns here on this position. Well, this is initial values. These are 35 days out in time. Cipher mining. That looks interesting, doesn't it? Up 128 today when gold and silver were down. Array Technologies, that's always one of the lower price stocks here, but here's Hut Mining. Why am I seeing all these mining stocks? Why am I seeing uranium stocks, Joby Aviation? Wow, that's at 1543. I've got a gentleman that does coaching sessions with Ernie and myself who brought this to our attention about a year ago, I think when it was $4 per share, $4.50 per share. His cost base was actually $3 per share. But why am I seeing these positions here that all look like a lot of mining, metallurgy, but yeah, some other robotics companies here, aviation, energy fuels? It's because we're looking for stocks that are in an uptrend and don't have earnings between now and expiration. But these premiums look rich. They're 30 to 45 days out in time. Okay. And we're going in the money here. We're looking for a good probability, 70% range, 73% range, 74% range. This is much higher than I expected. Maybe there's a wide bid-ask spread here on Cypher. Not terrible, but pretty wide. Pretty wide here on EOS. Yeah, these are okay. This one's not bad. Array Technologies though, 190 to 225, so a midpoint of maybe 205. That looks pretty good for the sell. 235 to 3. Okay, so it'd be about 260, 270. But a net debit of 60 cents. Lower price, only $1 there, but that's a 66.7% return with a 72% probability. Where am I going with all this? Okay. We were just talking about probabilities, and we're in the 70% range here with some of these double digits on these leverage trades. A gentleman asked, specifically he wants to look for stocks that match his criteria that he uses for stock selection. I don't know all of them yet, but he's looking for something I just pointed out on the AGI position, looking for that MACD bottom, looking for bottoming stocks, something that is just coming off the lower Bollinger Band, for example. He's using Keltner channels, actually, as one of his views, with the mix of the SMA 20 and others. And then he's saying, but isn't there a way with these leverage options that I can get a 1 to 10 risk-reward ratio? Or a 1 to 20 risk-reward ratio? Well, the answer is yes. The problem is Kelly criterion and the trade simulator tool will show you that the low probability of making the maximum return on that on a consistent basis is less than 15 to 10%. Meaning it's not going to pan out long term. Many of you who are experienced options investors, you've gone through this. You've seen the different trades mentioned. People talk about, okay, Cypher is at 1880. Well, you can make 50%, 70% just by a 22 or 23 strike call for 10 cents. If the stock moves up a little bit, you can sell to close it for 15 cents. There was a gentleman I remember years ago, it's probably 10 to 15 years ago, who was selling his product on buying 12 to 15% out of the money calls for less than a dime. He was looking at, okay, maybe less than a quarter, I think it was. But he was going 10 to 12% out of the money looking for positions that were only 25 or 20 cents per contract. And as soon as one went up to 30, he sold to close it. He's like, you'll maximize your profit this way. You're making 50% profit on every trade. But you're risking 100% on the 20 cents you paid. And if the stock even falls 40 or 50 cents, you're at a 50 or 60% loss. He was expecting to lose 80 to 90% of the time. He was successful in a bullish market. He was a failure in a neutral market. And he was a failure in a bearish market, obviously. And he didn't last too long, but it showed promise because he was showing 50 to 80 to 90% returns on 80 to 90% of his trades. How can that go wrong? Because the math doesn't work that way. If I lose 50% of what I put into a trade, right? I don't need 50% on my next trade to get back to break even. I need 100% on what I have left. And if he loses 100%, he needs about 215 of what he doesn't have remaining to get back to break even. This is re-illustrating, of course, and reinforcing the concepts of the married puts and controlling risk to single-digit percents, or buying calls themselves properly. Sorry, going through all of this, there is a way to find positions that have a 1 to 10 risk-reward ratio or a 10 to 1 reward-to-risk ratio with debit spreads. I would only do this with debit spreads. I'd never do it with credit spreads, the parity trade, because you'd be in the money and you'd probably be assigned right away. And not assigned for the maximum profit, you'd be assigned for the maximum loss. So you'd only do this with debit spreads. But what are we talking about here? We're talking about a position. Let's just go to February. Let's just go to standard expiration. And we can do this with weeklies too. And what do I want close to it? I think it's a 350. We'll just start with a 350% return on the position. Now I'm going to look for some open interest, well, at least 50 contracts. Option volume today, at least 10. I'm going to leave strike difference at any for now. I'm not going to touch in the money or out of the money. But the other component of this search that this gentleman was asking, is it possible to find 10 to 1 reward to risk ratios, or 1 to 10 risk to reward ratios, using options. Okay, so I'm just going to put things here. We're not going to worry about fundamentals or technicals, and I'm going to put my net debit. All right, so this is a net credit. I want it to be greater than negative point. No, negative 250. So I'm going to look for some higher price stocks here. So this means a debit of less than 250 if I set this up correctly. Let me go ahead and run that. Okay, so that's fine. It's more than 600 results. I expected that. Let's do some other control. And probability of at least 70%. Now, right away, we know we're not going to find anything, right? Nothing. We went from over 600 to none because they don't have that probability. What about a probability of at least 20%? Meaning it goes above both strike prices. And we're loading something here. Biotech. Gold. All right, let's take a look at the gold one. All right, so we saw gold pull back today. Talked about AGI most of the morning, evening. GLD is at 421.29. Bull Call Debit spread, selling a call and then buying a lower strike call at a debit to get the difference in strike prices. If I get the midpoint on this position, it's a net credit. But look at this return, 3,900%. Wow, that's fantastic. But what am I doing on this? I am so far out of the money. The stock price is here at 421. I'm buying a 445 for 35 days out. I'm selling a 446. I'm getting I'm paying $2 maybe per contract, $3 per contract. The max profit is 98. That's well above the 1 to 10 risk to reward ratio, 1 to 20 risk reward ratio he's looking for. But maximum profit is at 446, which roughly has what? Let's go to the option chain for our February series. Oh, this was standard, wasn't it? Yeah, 35 days out. My apologies. 20%. I paid 2 cents, 3 cents. Let's call it 3 cents for the 445. The 445 is only 21.5% probability that it's going to be at that strike to break even. See, here we go again. When we talked about that married put for AGI, we needed it to be at 44.80, only if we held it to June and made no adjustments. In this scenario, buying this risk reward ratio, which is beyond the 1 to 20 risk to reward or 1 to 10 risk reward he was looking for, you're looking at a 21% probability. It's less than the probability we had on that in the money married put of hitting break even or hitting profitability. Okay, so let's control this a little bit better. How are we going to control this? Let's use that search function. Let's go up to probability. I'm going to go to 40, maybe 45, but let's go to 40. Theoretical probability the stock's going to be trading at or above our sold call strike price. And we got Voyager again. This is much more realistic, but again, it's depending on, you're not getting the midpoint here. Sorry. The 36 strike. This return here, this 39% return, this 3 cent net credit is based on the midpoint. 280 to 380. Oh, okay, it's $1, so I should get 330 for this now. You're probably getting 3. You're not getting 330. And 255 to 410. Okay, so I can probably get around 310 or 320, 325. No, you're probably getting closer to 385, 390 on this bid ask spread. Let's find something that's a little bit, let's control it, ladies and gentlemen. Short bid-ask spread, less than 50%, and those are all close. I'm actually going to reduce this to 35. My apologies. I'm going to control the bid-ask spread. I have the volume and open interest in there, so these are active options, but you're fighting a bid-ask spread. There we go. Intuitive. Let's stick with that one. Higher price security, but this is an out-of-the-money bull call debit spread. Still wide bid-ask spread there because it's so high. I'm looking. Let me find something more controlled. A lot of these aren't controlled at all. Might have to go lower. No, I like the in the money one. I like Northrop. Northrop Grumman, 66690, excuse me. Slightly in the money, 655 call, 3130 to 36.9. Now that seems like a lot. It's a 5-point difference almost in the bid-ask spread. But with prices so high, I don't think 33 is out of the range. I don't think 33.30 is out of the range for this one. 32, same, 37.60. I don't think 34.50, 34.80 is a bad estimate on that. I think that's pretty good. But here, the return, 354. What am I talking about? If I got the midpoint, I'm paying a debit of 110 on a 5-point strike difference. So the maximum profit is going to be, profit and loss chart is going to be 390 against 110. Now that's 3 to 1, more or less. It's not the 10 to 1 he was looking for, but it's the 354 potential profit, and the stock is trading above that strike price. And what is the probability the stock would be above 655? That was February expiration. I don't know. I got to check that, Jim. Just give me 1 second. Yeah, 33.70 as I mentioned for the 655, which is our sell, and 34.80. I think that's possible. I think that's probable. But again, the probability is at 57% on Northrop Grumman. 57% that we'd stay above 655. Jim had mentioned that, something's got to be going on there. Do they have earnings coming up between now and expiration? They must. It's not selected. I thought it was on the default search we started with, Jim. Usually it is for our debit spreads and credit spreads. Let me go to the stock research tool here. Yep, 127. You're absolutely 100% correct, Jim. That's why the bid-ask spreads are wide. That's why this premium looks so strong for this debit spread. So 350% return, the minimum we were looking for. 40% probability or more, limiting the bid-ask spread. Let's go to fundamentals, shall we? Not between now and expiration. I'm going to give it a 78% probability that no results come up. Nope, we got Applied Digital. Fantastic. Bid-ask spread on the short is very reasonable. Bid-ask spread on the long, 510 to 640, a little bit questionable. $1.30 in that case. But a 35.34 with a net debit of 15 to 20 cents at midpoint prices. Let's take a look at that profit and loss chart. And probability above 58.9%. All right. Now, where I'm going, by the way, I know we're walking through this exercise. Where I'm going with all of this is we're seeing some different numbers here and we're seeing some different values. What I'm attempting to illustrate, pay 15 to make 85. Yeah, not quite 10 to 1. The max profit should be around 150 for the 10 to 1 risk reward ratio, right? But what we're 58% probability in this case. What I'm illustrating here is that PowerOptions will find you those positions, depending on the criteria that you put in. I found a couple for him that had the 10 to 1 reward to risk ratio, and even most of them around 12%. The probability was at 15. He was looking, the only way to find those are usually with out of the money debit spreads on the positions, meaning that you're selling a call that's above, like we were looking at here, but maybe not this much. Let's find a good 10 to 1. Maybe even higher than that. We'll stick with the standard February expiration on GLD, ETF, affected by earnings by its constituents, but not affected by earnings directly. 423. I'm going to buy the 423 call that's out of the money. And I don't want to go 7 points, but I really think I do. No, 7 points. I'm sorry, 8 points here at 3. I'm going to go high. I'm going to go 435. Sorry, folks. So 423 to 435, 13-point difference. 670 midpoint, 1130 midpoint, both look reasonable. Is this, it's close to what I want, but let's go ahead and submit that. We'll just do 1 and 1, 1130, 670, debit of 460 on a spread of 13. No, it's not 10 to 1. Okay, it had to be further out of the money. But you see here, you have the potential for 161% return. But again, your probability here is in that 30 to 40% range. So those trades are possible, but not likely to be successful long-term. It requires more management. It's not just fire and forget. That was kind of the other principle. Is, can I just put this on, not watch it, maybe just go 2, 3, 4 weeks out in time and not watch it and then check it in 5 or 10 days if the stock's moving up as I expect. Well, sure you can, but that's not the approach that can be successful long-term. And again, you're seeing what we do. Why wouldn't you do this, Mike, with a bull put credit spread with gold at 421? Why wouldn't you sell the 435 put and buy the 423 call and take a credit in? Because you see early assignment on the puts normally faster than you do with the calls. So someone out here holding this 435 put, I go ahead and sell it. I enter the pool. They might exercise or sell to close their 435 put. And then the market maker says, oh, finally, someone got rid of this. So I got to assign this here. But Mike, you have the protection. You're good here. Yeah, but if the stock's still down here, what did I do? In 2 days, I just hit my maximum loss of 460, 100% of what I invested into the trade. This approach, the at or out of the money debit spreads with the 1-to-1, 1-to-2 risk to reward ratios, or the 1-to-10, 1-to-20, which are deep out of the money, as I mentioned, with that 15% probability of full success, number one, should only be done with a small portion of your portfolio. And number two, the ones we look for in our sample searches on Bull Call Debits, the out in time, at the money bull put debit spreads, we're sort of straddling the position. Trust Financial at $49.99, selling the at the money 50 call to maximize the at the money bell curve and buying the slightly in the money. 40 and 50% probabilities, potential for, you see, high returns here. But we would close this. This is 63 days out in time, 119, 91 days out in time. Upwork, 91 days out in time. We're following this approach that was sort of shown to us as everyone. We had our bull put credit spreads that we were doing very, very well with. And then we started seeing these concepts of this at or out of the money bull call debit spread with a 1-to-1 risk reward ratio. I have a 2.5 point spread that I paid $1.70 to enter. Well, here I've got a 5 point spread that I paid $2.63 to enter. It's almost a 1-to-1 risk reward ratio. Only a 49% probability, but a potential for 90% return. But you don't look for that. You close this position when you hit 45% return. When you hit 39% return, when you hit 44, you close it at 50% profit. And you also close it at 50% loss. You're not looking to hold it all the way 63 days, 91 days, 119 days out in time. There's management that comes with this to be successful long term. And it's not just fire and forget. But yes, you can find the positions that have closer to that 1-to-5 risk to reward ratio, 1-to-10 risk to reward ratio, but the probability is so low of ever getting that range. But if you've got a better stock selection process than me, you can find stocks consistently that go up 8, 9, 10% in a 1 to 2 week period. That's going to be very profitable for you. And by the way, you don't need my help. You're going to be sitting on the beach somewhere just having that work for you. Okay? So I just wanted to illustrate that. The give and take and the concept of conflicting criteria. Is there something out there that gives me a 1-to-10 risk reward ratio? Well, yeah, you can find them with the spreads with leverage options, but you're talking about a 10, 15, 20% theoretical probability of making that full return. 80% of the time, you're going to be in this range where maybe 10% of the time you have a good gain. 20% of the time you have a small gain. 20% of the time you have a small loss. 10% of the time you have a large loss. 20 to 50%, probably closer to 40%. I know I've gone over 100% now, but probably closer to 35 or 40%. You're going to have the full loss of 100% on those trades. It's not a successful trading method without consistent management.